You know what's interesting? Some of the wealthiest real estate investors I've ever worked with would never qualify for their own mortgage using traditional lending guidelines. Seriously, they've got cash flow, they own properties, they're making money, but on paper, their tax return looks terrible. And that's because smart investors write things off. They use depreciation, business deductions, expenses, losses. So traditional underwriting sometimes punishes the exact people who are actually succeeding financially. And that's where DSCR loans come in. If you're a real estate investor or thinking about becoming one, this may be one of the most important loan programs you've ever learned about. Because a DSCR loan can allow you to qualify primarily based on the property's income, not your personal income. And that changes everything. So let's break this down in plain English. What is a DSCR loan? DSCR stands for Debt Service Coverage Ratio. Sounds complicated. It's actually very simple. All the lender is really asking is this: does the property make enough money to cover the mortgage payment? That's it. They're comparing the rental income against the property's monthly housing expense. So, if a property rents for $3,000 a month and the total mortgage payment is $2,400, the property cash flows. And that's what lenders want to see. And unlike conventional loans, many DSCR loans do not require tax returns, W-2s, pay stubs, or employment verification. That's why these loans have exploded in popularity with self-employed borrowers, business owners, real estate investors, Airbnb operators, and people trying to scale rental portfolios quickly. Now, let's address something important. A lot of people hear no income verification and immediately think, wait, is this sketchy? No. These are legitimate mortgage products. They're just designed differently. Traditional loans qualify the borrower. DSCR loans focus more on qualifying the asset. That's the big difference. Now, here's where people get confused. They think if I own an investment property, I automatically qualify. Not necessarily. There are still guidelines. Your credit score matters. Your down payment matters. Your reserves matter. And most importantly, the property itself matters. Because if the numbers don't work, the deal may not work. Let me give you a simple example. Let's say you're buying a rental property for $300,000. The total monthly payment, including principal, interest, taxes, insurance, and HOA, comes out to $2,500 per month. Now, let's say the market rent supports $3,000 per month. That's a strong scenario because the property is generating more income than the debt obligation. That's what lenders like to see. Now, the DSCR ratio itself is calculated like this: rental income divided by housing expense. So, in this example, 3,000 divided by 2,500 equals a 1.2 DSCR ratio. Generally speaking, a 1.0 DSCR ratio means the property qualifies. Anything above 1.0 is stronger. Below 1.0 can become more difficult, although some lenders still allow it depending on the overall scenario. And this is where strategy matters because not all DSCR lenders are the same. Some allow short-term rental income, Airbnb income, LLC ownership, interest-only options, unlimited finance properties, lower DSCR ratios, and foreign national borrowers. Others don't. So the structure of the deal matters a lot. Now let's talk about who these loans are really great for. Number one, self-employed borrowers. This is huge. I've seen borrowers making excellent money, but because of tax write-offs, their adjusted gross income looks tiny on paper. Traditional underwriting destroys them. DSCR loans can completely change the conversation. Number two, investors scaling quickly. Conventional financing starts becoming restrictive once you own multiple properties. DSCR lending is often much more investor friendly, especially for portfolio growth. Number three, people buying cash flow focused properties, especially in markets where rents are strong, because the stronger the cash flow, the easier the deal becomes. Now, let me give you one of the biggest mistakes I see investors make. They focus only on interest rate. That's a mistake. The structure matters just as much, maybe more, because sometimes investors get obsessed with chasing the absolute lowest rate while ignoring things like prepayment penalties, loan flexibility, reserve requirements, exit strategy, and refinance options later. A smart investor looks at the entire picture, not just one number. Another mistake, trying to force a conventional loan into an investor scenario that clearly fits the SCR better. I see this constantly. People waste weeks, sometimes months, trying to document income in ways that make no sense, when the property itself already tells the story. Sometimes the cleanest loan is the best loan. Now, let's talk about short-term rentals for a second. This is one of the hottest areas in DSCR lending right now. Some lenders will actually use projected Airbnb income from approved data sources. That can dramatically increase qualifying power in the right markets. But this is also where inexperienced lenders get borrowers into trouble, because not every condo allows short-term rentals. Not every city allows them. And not every lender treats Airbnb income the same way. So you need somebody who understands both the loan side and the investor strategy side. Another huge advantage with DSCR loans, many investors close these loans in LLCs. That matters, especially for liability planning and portfolio structure. Again, not every lender allows this, but many investor-focused lenders do. Now, let's talk honestly about rates. DSCR rates are usually higher than conventional owner-occupied financing. That's normal. These are investment loans with different risk structures. But here's what smart investors understand. Cash flow matters more than chasing perfection. A slightly higher rent on a profitable property can still be an incredible investment, especially if the property appreciates, rents rise, or the borrower refinances later. Sophisticated investors understand leverage. And here's the reality most people won't tell you. A lot of investors use DSCR loans not because they have to, because they want to, because it's simpler, cleaner, faster, and it allows them to keep scaling without turning every mortgage application into a forensic accounting investigation. So, if you're an investor or thinking about becoming one, here's the takeaway. DSCR loans are not magic, they're not loopholes, and they're not for every scenario. But for the right borrower, they can be one of the most powerful tools in real estate investing, especially if you understand cash flow, leverage, long-term strategy, and financing structure. Because smart investors don't just buy properties, they learn how to finance them intelligently. If you've got questions about DSCR loans, investment properties, Airbnb financing, or scaling a rental portfolio, reach out. I'd be happy to walk you through your scenario and help you understand what options make sense for you.